Hello, everyone, and welcome to the October Market Compass. Now, October is Halloween month, but does that mean it has to be spooky for investors? Historically, October is a more volatile month than average in stock markets. In fact, since 1950, research shows that there are more 1% or higher swings in October than any other month. This October, we have started to see signs of that volatility, with the S&P 500 experiencing its biggest one-day drawdown since April earlier in October, near 3%. Now, that VIX volatility index, also known as the Wall Street Fear Gauge, had also inched higher, closer to 20 levels, after being in the mid-teens for the past several months. However, keep in mind, every year is unique, and markets have been rallying steadily since mid-April, with the S&P 500 climbing over 30% without a 5% plus pullback. So we could be due for a period of consolidation or some profit taking after a nice run higher. And the markets certainly have had several challenges or walls of worry to climb in recent weeks, including the extended tariff uncertainty, especially between the US and China, which weighs on consumer prices and inflation. The ongoing US government shutdown, which also weighs on economic growth each week it continues. And of course, some emerging concerns around the credit quality of smaller US regional banks, which seem contained for now, but are worth monitoring closely. Now, despite the building concerns, we don't see a pullback or correction turning into a deep or prolonged bear market. Now, why is that? Well, there are some positive momentum factors as we head into year-end and into 2026. First, the Fed is likely to continue cutting rates, which should support both the consumer and economic growth. Second, the US tax bill should kick in next year, which is supportive of companies spending on CapEx and R&D. And finally, corporate earnings growth continues to deliver. In fact, the expectation is that S&P 500 earnings growth will grow about 11% this year and accelerate to about 13.5% in 2026, driven by both tech and non-tech sectors. Now, overall, if we do experience a pullback in the weeks ahead, there are ways that investors could likely take advantage. We recommend considering 3 actions. Number 1, rebalancing. As equity markets rallied, parts of portfolios may have grown beyond what was originally intended. For example, a balanced portfolio with 60% equities and 40% bonds may now be much more heavily weighted in equities. So this is a good opportunity to consider rebalancing this portfolio to get aligned with the desired equity and bond risk balance. Number 2, diversifying. Now, given the outsized rally in a few key sectors, including technology and AI, investors may want to consider diversification in their portfolios, especially into those parts of the market that have some more scope for catch-up. Now, this could come by trimming gains and winners and reallocating, or by putting new money to work as well. And number 3, adding quality investments. Now, if markets do experience a correction or pullback, investors should consider being prepared. Have a list of potential quality investments that align with your strategic allocations ready in order to use market corrections as opportunities to add to portfolios. While regularly using dollar cost averaging to make investments is an established strategy, there may be times that call for more opportunistic investments. So while October has the potential to bring some scary market uncertainty, if investors are prepared, volatility can become an opportunity. If you need guidance, talk to your financial advisor about strategies like rebalancing, diversifying, and adding quality investments at better prices. They can be your best resource to help make sure your investments are aligned with your personal long-term financial goals. And with that, I thank you, and we'll see you right back here for the November Market Compass.